In this lecture we will discuss budgeting. It is very important that a business makes sure that it can meet all of its cash needs. Budgeting is an important part of this planning. With budgeting, a firm estimates how much money that it will bring in and how much money it will pay out. If there is an estimated shortfall, the firm estimates how it will cover the shortfall. The starting point in the budgeting process is the sales budget. Everything flows from this budget. Here a firm states how much business it will do. If it is a manufacturing firm, this is where the firm states how many units it expects to sell during the year. In this chart, you can see how the different budgets are related. Once you determine how many units you will sell in the sales budget, you can then determine how many units you will produce and when you will produce them. This is done in the production budget, which is the blue box. Once you determine how many units you will be making, you then can budget how much you will spend on direct labor. This is done in the direct labor budget, which is the green box. You can also determine how much your firm will spend on direct materials. This is done in the direct materials budget, which is the baby blue box. You can also determine how much your firm will spend on factory overhead. This is done in the factory overhead budget, which is the pale yellow box. Once you know many units that you will make and sell, you can determine how much your firm will spend on selling general and administrative expenses. This is done in the selling general and administrative budget, which is the purple box under the sales budget. Now that your firm knows how much it will spend and how much it will receive, it can construct the cash budget, as well as the budgeted income statement and balance sheet. These are the boxes in the lower part of the drawing. Now we will do an example of using the different budgets. Assume that a firm sells movie screens. The sale budget would state how many units are sold in each quarter. When you multiply the number of units sold by the price that the units sell for, you get the estimated sales revenue for a given period. Now that you know how many units that your firm is going to sell, you have to determine how many units your firm is going to make. Take a good look at the setup of this budget. It comes in handy when answering questions on budgeting. You start with the number of units that your firm is going to sell. You need to have that many units. On top of those units, your firm also wants to have extra units on hand with which it can start the next quarter. This is the ending inventory. If you add these two numbers of units together, you will have the number of units that your firm will need in a given quarter. Now that you have the number of units that your firm will need for a given quarter, you can subtract the units that your firm already has when the quarter starts. This is the beginning inventory for that quarter. What you have left is the number of units that your firm will need that it doesn't already have. These are the units that it must produce during that quarter. Notice the arrows that point from the ending inventory in the first quarter. One of the arrows points to the units expected to be sold in the next quarter. This is because the number of units that a firm keeps in its ending inventory for a quarter is usually tied to the number of units that the firm expects to sell in the next quarter. If you look at the notes at the right of the slide, you can see that the ending inventory is 25% of the units expected to be sold in the next quarter. The other arrow points to the beginning inventory in the next quarter. This is because one quarter's ending inventory is the next quarter's beginning inventory. This slide shows you the direct materials budget for your firm. The beginning numbers come from the number of units that you determined would be produced by your firm for the given quarter in the production budget. Based on those estimates, you can determine how much your firm will spend on direct materials. This slide shows the direct labor budget for your firm. Once again, the number flows from the number of units that you determined that your firm will produce in the production budget. Based on those estimates, you can determine how many direct labor hours your firm will have in a given quarter, and how much your firm will spend on direct labor in those quarters. This slide shows you the factory overhead budget for your firm. This budget starts with the direct labor hours that you calculated in the direct labor budget. Based on this number, it calculates the firm's variable overhead. You then add the estimated fixed overhead to get the firm's estimated total overhead. Notice that in the notes to the side of the total overhead, you can see the calculation of the predetermined overhead rate for the next year, which is the estimated total overhead of $357,825 divided by the estimated direct labor hours of 27,525. This is the selling general and administrative budget for your firm. Notice how all of the figures flow from the estimated number of units sold that was determined in the sales budget. This is the cash budget. The numbers come from the various budgets discussed earlier. Notice that a cash deficit is estimated in the second quarter due to an equipment purchase. The cash budget anticipates covering this deficit with a borrowing. Notice that in the third and fourth quarters, payments of interest and principal on this loan are anticipated. What you have seen is a static budget with one level of activity assumed. You could also have a flexible budget where various activity levels are assumed. This is an example of a flexible budget. It shows budgeted costs at 3 levels of production. When you have a budget, it is helpful if you look at where your actual costs differ from your budgeted costs. The differences between the actual and budgeted costs are called variances. We will discuss variances in our next lecture. The end.